where we've just seen this Goldilocks GDP print of 2.4%, really feeding into the soft landing narrative in the United States. At the same time, though, the FOMC and the ECB still hiking rates. Where does that leave talk of a recession, at least in the US? Is it behind us?
Our view is there's not so much, we see it as what we call a rolling recession, which is while you have the ordinary factors of a traditional recession are the entire economy drops in a V fashion. You see economic growth drop off and then it recovers 6 to 9 months later. What we see right now is much more nuanced. We see underlying factors within the economy actually currently in recession. So a few of the different, a few of the different factors such as housing, where you've seen that really in a recessionary state, commercial real estate also. If you look at that platform, that's been in recessionary territory over the course of the last 9 months. However, you do see considerable growth at the top line as evidenced by what you're seeing in stock markets. So while the overall economic growth has been very strong, while employment has been very strong, there are pockets of recession that are going on. And it is still recession, but what that likely means is we're going to see tepid growth, if not positive growth, stretching out much longer than originally expected into 2024.
What will that mean for risk assets? I think one of the key messages that we've heard from these central banks this week is that they are going to be data dependent. They're watching growth, they're watching the employment rate, they're watching inflation. Where does that leave the equity outlook from here? Will we see stocks moving higher in the second half, or is there perhaps some reason to stay cautious out there right now?
If we look at history as a guide, history tells us that Q3 will probably be a fairly sideways period before Q4. In the U.S. specifically, we start to see equity valuations rise as there's a lot of window dressing and profit chasing towards year end. However, when you look at structurally at the companies, the earnings growth, that was the big problem with valuations, was that will earnings growth come through? We're seeing the Q2 earnings reports coming in the U.S., and they are meeting expectations largely. So with that is the backdrop. What we do expect is more constructive views on equity markets in the U.S. throughout the rest of this year. The Magnificent Seven, as they're called, they tend to be driving a lot of the headlines. What we think is more likely in the second half is a rotation away from those largest companies into more of the companies that we look at the small and mid-cap space, where valuations are roughly half of what you see in the NASDAQ index, for example. So I think we're constructive on U.S. equities heading into the rest of this year. Global equities, though, still remain the major opportunity. And Japan, after a major run-up, is another unique opportunity. Again, earnings are coming in well ahead of expectations on the heels of that strong growth mentioned by the BOJ earlier. So there are many opportunities for investors to get invested and remain fully invested, which unfortunately we're seeing a lot of investors right now still massively underweight equities relative to being overweight cash. That's a huge opportunity which will support markets in the second half of the year.